Guys, it's Doc's Market Minute for Wednesday, November 25th. Now, yesterday we went over part one of the Iron Condor, and we showed that a good defense actually starts with a good offense. So what we had tried to do, if we go expand this out here, is to set up these trades for December with a 218-220. So we had our short strike up here, again, well above current resistance for 2015. And then we used the first pullback that we saw with the associated VIX spike that we had, so a little spike in implied volatility down here, to get the 190s. So we had an Iron Condor that was essentially the equivalent of 280 points wide on the full S&Ps. So that was my point from session number one on the Iron Condor, is that if you understand price action, you understand what the price is telling you on the chart, then you can use price action to help expand the width of the wings of the Iron Condor. So again, to me, a good defense starts with a good offense. Now, you could certainly just place these both at the same time, like most Iron Condor entries, but typically when you do that, you're just not going to get as wide a wingspan versus if you work it a little bit, if you're patient and understand what the price is telling you. All right, so now once we put our wings in play, is there anything else that we use on the chart to help defend the trades? Well, the answer is no. So even though we have some great trend lines here and the price should stay below these in the short term, what I've found is over the years is that sometimes price is just going to do what price is going to do. And this is where a lot of retail traders get shocked, like, wait a minute, the price wasn't supposed to go through that trend line? Or the price was supposed to bounce off that support level. Why did it keep on going? Again, price can do whatever it wants to do. So what I'm suggesting at this point is that once you've got your positions in play, that you forget about the chart. The chart is not going to help you anymore to defend that trade. In fact, all it's going to do is going to hurt you, because you're going to be married to certain technical aspects of the chart. So in other words, if we see the price just blow up above all-time highs here at 2135 on the full S&Ps, I'm not going to be shocked. Maybe I was at one point saying, well, it shouldn't go above all-time highs, but honestly, we've seen that type of behavior for the past 6 years where price just blows by the former highs like they didn't even exist. So even though overhead supply should be part of how resistance is treated, again, you can't trust it anymore. So once you've done the best you can to widen out the wings of the Iron Condor on your offense, then it's time to lay back and play defense. It's almost like kicking the ball off in a football game, right? You kick it as far as you possibly can. You send that other team as far to the other end of the field as you possibly can, and you make them work that entire field, if at all possible. You don't want to give them any advantages. And this, in essence, is what we're doing, is we're kicking the ball off to the market and saying, okay, come after my goal lines. Let's see what you got. All right, so now it's time to lay back and play defense. How do we do that? Okay, so here's our risk graph of this position, and just a word about defense first of all. Now, what you'll find is that a lot of the best defense that you'll play is set up before you even enter the trade. So where I start my foundation for defense is down here in what I call general risk management. This is, in essence, this is position sizing. So we have to have the right position sizing that I'm not going to create too much risk. If you create too much risk for the position, you won't be sleeping at night, and you're going to be focusing on what might potentially happen to you instead of actually focusing on managing the trade like you should be. So position sizing is the first thing that I take care of, and this is by identifying the exits and identifying the correct position size even before I place the trade. I think it's so important. So these are just the basics. This is the foundation, but many people just sort of skip that over and say, well, I always trade 10 contracts. Why shouldn't I? They're more focused on what they can make instead of what they can lose. The problem is, when you trade these types of Iron Condors, you're looking at potentially what's called the black hole here. So this is the black hole. This is the place from whence you never return. So you can trade these trades, 10 times in a row. You're going to be profitable with this nice wide range here. And then the 11th time comes along, and all of a sudden the price makes a move that you didn't expect or you don't agree with, more likely. A lot of times this is where I see retail traders arguing against the price. It shouldn't happen, or Yellen did that, or why does Mario Draghi, announce these things right before expiration? Things like any excuse, it doesn't matter. Price is going to do what the price is going to do. Next thing you know, you've got the price way up here and you're in the black hole. And this is where so many traders get trapped, where they give back perhaps 10 cycles of profits in one trade. And it's devastating, not only to your account, but also your confidence. So what happens after that is that you start trading not to lose. Trading not to lose. And this is also fatal, because when you trade not to lose instead of trading to win, then what you're doing is in essence, you're waiting until something feels good before you trade it. And actually, that's probably the worst thing you can possibly do. If you're waiting for something to feel good before you trade it, usually you're trading with the herd, you're trading along with the mainstream media, and you're about to get faded. And so this is where people get into that death spiral, trading not to lose. And the more conservative and the harder that they try not to lose, they find that they can't break this cycle. So this is very, very common. Okay, so that's step one, position sizing, getting your head screwed on straight. Number two is what I call static risk management. Static risk management here. And in essence, what I'm doing is I'm enforcing a 1-to-1 reward the risk on this trade. So instead of a 10-to-1 or 8-to-1 like it is right now, I'm enforcing 1-to-1. So if I'm getting a 15-cent credit down here, 15-cent credit down here, or up here on a $2 wide spread, I don't want to take that $1.85 loss up here. I don't want to get into the black hole. So what I do is I specify, okay, if I'm getting 30 cents of credit on the whole trade, what exit would factor in with a 30-cent loss on the entire trade? And so this is what I impress upon that. If you need more details on this, I do have courses that show how to set up the static risk management exit. Okay, so that's out there. They're affordable. So this is what I do, static risk management. And then if I do have to exit this trade, what I do is called the rollout. So I'll shut this down and I'll roll this further out in distance, and it's usually time, because it usually takes a while for this attack to occur. And so we'll take that short-term debit, roll it out, and the trade's not over until I say it's over. So if it takes a cycle or 2 cycles to recover from that, then I view the entire trade over those several cycles as one big trade, right? So I think it's also important from a mental perspective that you manage it like that. Okay, the last thing I want to talk about is, if you start out the trade with a price about right here, and it starts just inexorably creeping higher against you, you feel like you're on the train tracks here, and you're standing on the train tracks, and you're watching this train just bearing down on you from a long distance away. It's just, you see that big headlight, and it's getting closer and closer and closer, and this is all that you focus on. Isn't there something that you can do during this space, during this entire time between when you enter the trade to if you have to roll it out? Isn't there some way to make some kind of gains during this time? Well, absolutely there is. There's ways that you can hedge the position against this active move in price. And that's what I'm going to get into in the next segment, which I guess that's going to be Friday. So we'll cover that in part 3 of the Iron Condor series on Friday. So with that, you guys have a great Wednesday. Have a terrific holiday, Thanksgiving. Be thankful for everything that we have, including a free market, hopefully. and we'll see you on Friday. Take care.